Apparently it is heckler night. All right, I'm James Orr. And this thing doesn't work. There we go. I'm James Orr. Tonight I'm doing how to acquire, I guess I got to figure out what I'm teaching. How to acquire a multi-million-dollar investment portfolio while earning just $5,000 per month. I am James Orr. I'm a realtor with James Orr Real Estate Services. And apparently you should use Tammy Orr Real Estate Services because she actually answers her phone. Or so Royce tells me.
It's true.
So.
Oh, James will answer your watch.
What's that?
You'll answer your watch.
I do answer my fruit watch sometimes. Okay, so upcoming classes. Next week, Brian is teaching self-directed 401ks and IRAs for real estate investors. Brian, what is that class about?
How to use your 401k and IRA money and roll it into a self-directed 401k and self-directed IRA, and what the benefits and non-benefits of each one are, and how you can partner with other people using those two funds to help yourself invest in real estate.
Okay, cool. It's going to be a good class?
It's going to be terrible.
It's going to be terrible. That's good now.
It's not going to be amazing. I mean, it's hard to live up to that bar.
That is true. And then the week after that is 1031 exchanges for real estate investors. What is that one about?
That's what it's about. It's about 1031 exchanges, which is when you sell your property and you don't want to pay taxes on it, and then you roll the funds from the proceeds from your sale into a purchase of another property.
Okay, awesome. And then after that, the best real estate investing strategy ever. I am apparently teaching that on June 19th. That is going
What is
to
that,
be,
James?
What's that?
What is that, James?
It's going to be amazing. I will leave it at that for now. And then I'm going to teach house hacking versus Nomad. Anybody know what house hacking is? Anyone not know what house hacking is? All right. Anyone know what Nomad is? Anyone not know what Nomad is? Awesome. You guys got to come to that class then. And then Financial Independence Day.
Does not count as you teaching.
It does count as me teaching.
You canceled class, so you cheated yourself out of the ability to cheat.
I have 60% of the classes on the schedule right now, and I'm teaching tonight.
You have 50% of the classes on the schedule.
What are you talking about? Financial independence is like a class.
The only reason you have the 19th and the 26th is because I'm out of town, for clarity.
Is that the only reason I'm
And it got changed earlier today, so...
Financial Independence Day? No class?
Not the no class part.
Well, you guys are welcome to show up on Financial Independence Day class.
How long you meet up, what movie we'll watch?
What movie?
Someone joked about.
We already had the Financial Independence Retire Early class, because it's called what, James?
Oh my gosh, that's funny.
I will show up that day, and I will do like a substitute teacher, occasionally did in our classes, and just roll a TV to the front of the room.
I guess you're watching Electric Company or 3-2-1 Contact.
There's some really good shows in there. Anyway.
Grace doesn't even know what either of those are.
Really? You don't know what those are?
Do you know Sesame Street? Yeah. Okay.
Okay. It's the same thing. Same stuff.
Like the same thing.
Yeah. All right, so introductions. Who are you? And then what is Brian's best NCREG class? And what?
That's awesome.
I want to find out what people like best from you. That's what we're going to teach again. And then please do not take photos of slides or record audio or video of the NCREG presentation. And then Brian also likes to tell people to turn off their phone. Tonight, everyone has now been warned. Turn off your phone, because if your phone goes off during class, you will wear the red nose for the remainder of the class.
I thought you were going to threaten us with another course.
You're going to give away a free investor course? You'll get the Dave Delgado course. Okay, so actually the Dave Delgado course was good. It's just some of his stuff's a little bit. All right, so recordings are available on the podcast, which I'll talk to you about here in a second, and James Orr for clients. So Nomad Real Estate Investing Podcast. So it did get changed. How many people noticed the podcast went from like 130 episodes down to like 4? Anyone notice? Okay, cool. So I've been warning people for like 6 months that we were going from all 130 on there to the rolling 4 most recent. So the newest one gets posted on there, then like the 5th oldest one gets rolled off. So definitely come live and definitely listen to them before they get too old. You guys must be front row at this point tonight. And so those are the newest ones on there. Clients do get access to the old, like the whole vault of courses and stuff on the recordings on my website. So this is where you go to access the 4 most recent or whatever it is. And then occasionally what my intention is to pull one out of the vault and put it on there as like a surprise. So like
James Disney Orr.
James Disney Orr, yes, that's right. I'm taking a page out of the Disney playbook. We're going to pull things from the vault, and we'll remaster them and edit things out that are no longer correct, and we'll go from there. Okay, and there is another podcast coming, so stay tuned. I promise, there really is. All right, so how to acquire a multi-million-dollar investment portfolio while earning just $5,000 a month, apparently this time. So apparently I have a typo. Okay, so the Nomad original plan. Everyone who's come here has filled out a sheet and gotten a copy of this book, correct?
Hey, James.
Yeah.
You actually want to do intros?
Oh, yeah, let's just do that. So who are you? What's Brian's best anchoring class?
I'm Nick, and my favorite class was the EV class.
That was your favorite class?
Yeah.
Wow, that's actually out of like nowhere.
I need a pen to write this down.
Oh, yeah.
Tally this up.
Yeah, here's pen. You want to get Brian a pen, sorry?
Whiteboards.
But Brian will do the class. He'll write it down.
I'm Michelle, and my favorite class was probably Brian's interview or asset protection.
Whoa, Brian's interview. I never suspected that one was going to come up.
I'm Brian.
Okay, what was your favorite class? What's your favorite one to teach? I think I know what this one is.
My favorite one to teach, probably the one thing.
Yeah, I think that was what I was going to guess.
I'm Royce, and I don't think Brian teaches classes according to your schedule up there.
What do you mean? He teaches most of the classes.
Okay.
Like 2019 is the year that Brian teaches like 90%.
Yet to teach a class.
Oh yeah, your time is coming.
No red name tag.
Your time is coming. Alice, he needs a red name tag.
I don't know. I've seen so many of his classes. It's like asset protection. One thing is always good. I forgot about the EV class though. I really did like that one.
I do like that one.
EV.
EV, wow. I didn't expect that one. Hello.
I'm Nathan, and we've only been to one of Brian's classes, so we don't have much to pick from.
Which one was it?
2 weeks ago, the How to Acquire Your First Property, was it?
Oh,
Or,
was that any good?
It was, no, it was good.
I wasn't here. I heard it sucked.
Yeah.
I heard it was like the worst class ever. That's why I don't even show up for that class.
It was good information.
He's like, yeah, I know what's in that class. There's no way I'm teaching that the same way again.
So 2 weeks from now, when you expect me to show up and teach, and you don't show up, you'll know why.
Uh-oh. Uh-oh.
Hope you know how to teach that.
I don't know how to teach that one.
I'm Lindsay, so I'll have the same answers.
Was it the same class?
Yep.
Okay, awesome.
Yeah.
Did you guys listen to any of the podcasts before they got pulled down?
We tried.
Yeah.
We had a 7-hour drive that we listened to, like the first few.
Or were they none of Brian's?
No.
No, I think they're
Wow, that's crazy.
We know who's uploading them.
I mean, I upload everything. I try to use your stuff all the time. I do it all the time.
This is mine. This is Brian's.
Yeah, that's crazy.
Hi, I'm Eva. This is my second time going to a class, so
Yeah. What was the last one?
it was interview with a successful real estate
Oh,
investor.
so Brian didn't even teach anything. Yeah, that's
Yes.
kind of a bummer.
It's more of an interview of
Yeah.
the class. So.
Okay, awesome. Thank you.
My name's Mark. First time here.
Awesome. Thanks. Welcome.
My name is Sean. I have not been to any of Brian's classes, but I'm excited to attend.
Awesome. And we do speak into the microphone so we can record the podcast. I realize it doesn't project your voice, but other people will yell at me. They'll be like, hey, I can't hear people talking on the podcast.
Second take on Sean, first class.
Awesome.
Looking forward to Brian.
Good job.
I'm Kevin, and my favorite class was probably how to create a deal analysis spreadsheet.
Nice. How to create a spreadsheet. We're going to pull that one from the vault.
Like how to build it?
Yes.
What are you even
No, he wasn't. You just heard how bad it was.
I'm not writing that down.
My name's Grace, and I liked the not building the spreadsheet one, but just the deal analyst.
Oh, like the more recent one? Yeah. Okay, good.
I'm James. I actually really like the tenant screening one.
Oh,
with the packet where we broke down like how to tenant screen without violating fair housing.
Yeah, that's a good one. The workshop, tenant screening workshop.
I'm Emily. I did like the one thing that was a really great class.
Yeah, he does a good job with that.
I'm Mike. I also like the one thing that's my favorite class. I feel like Brian was like a therapist as much as a teacher.
Yes, I agree. He does get into that.
I'm Lynn. I got a whole lot out of asset protection.
Nice. It's good because that's the last time we were ever
I'm Bob,
teaching
and
that
I'm
class.
saying tenant screening.
Tenant screening?
Okay, I'm Barbie, and I'll say tenant screening. The one where you had all the stories. That was real good.
What stories? The horror story class?
Yeah, the horror story.
Oh my gosh.
Story time with like tenants.
No horror stories.
Yeah.
Actually, that was good.
That's so interesting that class came up as like a.
Bobby wasn't here.
That's when he came
Okay.
and said, I'm going to do it back.
Oh, sorry.
John, it's for you.
I've only been to a couple so far, so I'm sure there'll be a lot more to judge on.
Yeah, which ones do you like so far?
I like spreadsheet one.
Okay, yeah, the deal analysis spreadsheet.
What's
Yeah,
that?
the deal analysis spreadsheet.
Yeah.
Yeah, Brian actually just sent me over the final version of the spreadsheet, so I got to talk to him about what I'm going to do with it now.
It's 4.0.
4.0, that's awesome.
I'm Dwayne, and I like the first one I went to was the 2 weeks ago, first deal.
Oh, cool,
But
awesome.
then also, I just got done listening to 401k and self-directed IRA,
Oh, nice.
and it's fresh on my mind, so I actually got a lot out of that one.
Oh, very cool. That's going to be the same class coming up in a couple weeks.
There's going to be changes
Are there?
based on comments in last year's.
Oh, okay. Very cool. Yeah, we should go listen to
All the
him.
changes.
True.
I know some changes I'm making, but
I'm Dave, and this is my third time here.
Oh.
And I like Brian's teaching for sure.
As opposed to mine.
I haven't been to yours.
Everyone
I've been
does.
to yours.
Yeah.
This
Oh,
is the
this is your
first
first
time.
time? Uh-oh. This is not going to be good.
I was there
All right,
last
awesome.
week with the interview, and that was good too.
Okay.
So.
I tried to behave myself last week, although people told me I was yelling at people, so.
I'm Lynn, and I liked the spreadsheet that analyzes a potential purchase.
Wow. Do you guys want to see more like deal analysis, like how we analyze different deals? Raise your hand if you want to see that. Ooh, that's crazy. Those are classes I could actually teach. Maybe.
I'm Munir, and I did like the asset protection, but apparently I've got to go see the one thing.
One thing was your favorite one?
No, I've got everybody.
Oh, you haven't listened to that one?
No.
Oh, that's so
I must
weird.
have missed that.
We taught it twice too.
Yeah.
Yeah, that's weird. It's unusual for you because you just come no matter what the topic is.
Yeah.
Yeah.
You know what it is like in the evenings.
Yeah.
I'm Joe, and I would say deal analysis and hot seats.
Oh, hot seats.
Hot seats was.
Are you like signed up for hot seats again this year?
No, I can't bear it again, but it was a great class.
Yeah. I'm surprised you're still here. Everyone else who got a hot seat is no longer attends.
Oh, all right.
Yeah, he was too rough.
I'm Daryl. This is my first time here. So
Oh.
This is my favorite class so far.
Very cool. This is a good class for you to pick, although Brian doesn't teach it.
My name is Jamie, and I have only been to one full class, but I was listening to tenant screening about 20 minutes ago. I like that. That was nice.
Jamie, do you like do karaoke or like rap or anything like that?
Neither, but with I do things with microphones. Yes.
Because you like hold the microphone different than everyone else. You like have your finger over like the bulb thing on the top there.
Yeah.
It is. It's like crazy. It was like everyone else like timid holding it back here. Is it like the beatboxing? No. Because it'll blow out someone's speakers, and then I'll have to like edit it out, and it costs me $74. Wow. Maybe.
My name is Nolan. I've listened to so many of Brian's classes in the last 2 weeks, I couldn't possibly pick one. I would probably say tenant screening, though. I think that
Awesome.
one is really good.
Very cool.
My name's Timothy. It's my second time here, so I have yet to get a favorite class.
Okay. What was your first class?
Last week.
Oh, the interview.
Yeah.
Okay. Awesome. Very cool.
My name's Alex. I really enjoyed the deal analysis spreadsheet and the doing your first deal.
Nice. Awesome. Two good classes.
My name's Doug. I also enjoyed the deal analysis.
Okay. Very cool. Awesome. You pass that mic back to Brian. He's going to do control of mic.
Why don't you ask them what they want from deal analysis if we do more classes?
You have the mic right there. Really?
So everybody raised their hand for deal analysis classes. Like, if we taught one that was not like last time, what would you guys like to see? What do you want more deal analysis of?
Like different deals? You don't have to do the mic. Just tell me what it is. We'll repeat it.
Well, it was more...
Case studies.
This one was more, this is how the spreadsheet works, and you put this number in for this and this and that. But if we actually did a lot of case studies on it.
Okay.
So you want examples?
Yeah.
Yeah.
Okay.
Mike?
Coming up with rehab costs.
Some of the stuff that your software would do, like where you could put multiple properties together and
Oh.
and kind of do like almost like a deal analysis on portfolio optimization.
Yeah, it's more of a portfolio analysis class.
We do have a portfolio optimization class.
We do. We probably should update that within my new software.
Yeah, you can teach that now.
Nah.
Anything else?
Best deals on the market today, we pick them.
I think we try to pull that if we pulled examples. Go pull best deals.
Some helpful stuff with looking at like new and old properties and like making it specific for Fort Collins. Like, we're gonna get this neighborhood.
Okay. New versus old properties in Fort Collins and Loveland area. Anything else?
I was just thinking of how I skipped over this slide. I'm like, yep, all right, we'll just name it.
It's like when you ask people if they have any questions and then don't look.
Just keep teaching.
Yeah.
Yeah.
It was like that, only worse.
It was much worse. I agree with you. It's pretty funny.
Yeah. Anybody else? Going, gone.
All right. So the original plan. So how many people got, thank you, welcome everybody. How many people got this book? Is there anyone who's not gotten this book? Okay, Daryl, if you hand me your sheet, she'll give you one. Anyone else not get the book? Awesome. So that goes over the basics of the Nomad plan. So Nomad basically is this. It is buy a house as an owner occupant. You got to move in. You got to live there. We get a slightly lower interest rate. You can put in less down payment. You live there for a year. That is a requirement of the lender. The lender requires that you live there for a year. Then you buy a new home. You convert the other one to a rental. So you move out of the last house, you convert that one to a rental, and then you repeat the process until you have as many properties as you want as rentals. So you could do this once, you could do it twice, you could do it 10 times, you could do it 20 times. It doesn't matter. However many rentals you want, that's the plan for the original Nomad strategy. How many people came to the class where we went over how to acquire multi-million-dollar investment portfolio starting with $3,000? Raise your hands really high. It was the class where people stood up here for the duration of it. You guys remember that class? Okay, so that class was based on a book that I wrote that I gave away for Christmas. It was probably like 4 years ago now, whatever it was. And I gave away a whole bunch of copies of the book at that class. And it went over how to go and acquire, how to do Nomad, starting with a single $3,000 down payment, and how to go make a portfolio of, I think we ended up with like 15 properties. There's more than that in the book, but the class we did like 15 or something like that. And so that strategy, as you buy a house as an owner-occupant, same steps, you live there for a year, you then buy a new home, you convert the previous one to a lease option with a tenant buyer. Instead of just converting it to a straight rental, you do a lease option tenant buyer on that one, and then you replace sold properties with new properties. So if you have enough money to buy like a 20% down property, you do that part of it, and then you repeat this process until you get as many rentals as you want. So this is a much more aggressive plan. We use lease options. We use the option fee in order to pay for the down payment for the new one that we're buying. That's not this plan. This is the 3K one, okay? So this is that strategy. Now tonight, we are going to do, and this is, by the way, this one is based on a book that I wrote for the next Christmas, where I gave everyone who came to the Christmas party this book, which is How to Acquire a Multi-Million-Dollar Portfolio, making $5,000 per month. So the other one was, you have $3,000 that you're starting with. How can you do Nomad every single year very aggressively by using lease option tenant buyers? There's a seat right here if you wanted to. One right there too. So there's a couple. And there's a stool in the back if it gets down to that point. So, whoa. So the other one, the 3K one, was you start with 3K. The book this time is you make $5,000 a month. You're saving a really small amount, which I'll show you here in a second. And now you're actually, how long does it take you to save up for the first property that you're buying versus saying we're doing it in a year. You're going to use the tenant buyer to put the down payment up. Now we're saying how long does it take you to save your money and get to this point? Do you guys see the difference? Okay, so if you like, hey, I want to do this every year, but I have a very limited down payment, go look at the 3K class on the recording. It's still up on the podcast. Or go get the book. If you want to do the 5K one, that's tonight. And there's a book, and I don't think I'm covering the exact same thing in the book that I am in class. I can't teach a 200-page book in like 2 hours, but there's a bunch of, especially since we did intros for like an hour or 40 minutes or whatever, 30 minutes, however long it's been. I don't even know. But this is what this book is about. And so we'll go over some of that tonight. And I went and I listened to the recording. We try to listen to the recording when we teach a new class to find out what I said last time. And Royce had some pretty interesting insight in this last class. So I'm going to see if he says the same thing tonight. That's going to be the test. And I don't think you were here last time for this class, Brian. I don't think you were like attended. You were missing. I don't think you were. Really? I don't think he was. You were not on the mic at all. You have a question? No? You're good? Okay, cool. So Nomad with less moving. There's also a totally separate class on Nomad without moving at all, because remember, Nomad is you move into a property, you live there for a year, you convert it to a rental. There are variations of Nomad where you're doing sequential investing, where you do not need to move in. There's a separate 2-hour class on that. It's I don't think it's currently on the podcast, but it was on the podcast. It may come back from the vault, or it's on the website. Okay, so can you do this earning less than 5K? So when I first published this book, I had written the book, I had hired a designer to create the cover, I posted the cover on Facebook, and this is one of the reasons why I'm not on Facebook anymore, but I posted the cover on Facebook, and actually people were saying, come on, James, people don't make $5,000 a month. Not everyone makes $5,000 a month. And so I was pretty sensitive to that, because I thought $5,000 a month was a pretty reasonable expectation for stuff. So I went and I did a bunch of research to see if it was reasonable. And so I'm going to talk to you about that tonight here. Can you do this on earning less than 5K though? Yes, you can. You choke up on the bat. So when I first started thinking about this, I remember when I was playing baseball in high school. And I had this friend in high school, like incredibly stocky kid, like had muscles on top of muscles, relatively short guy, played third base, could just like whiz the ball really fast. He would sit up there, like they had these crazy, did you guys have these in high school? Eastman bats? Like the bats that had like these huge heads on the back of them. Like I don't know if you guys ever played wiffle ball, but like the red Bam Bam bats. You know, like the wiffle ball ones that have these huge heads. Am I like talking? No one knows what I'm talking about? Okay, yeah. So you have these like really big ones. So he had like this Eastman bat. It was like 39 inches long, and it had this like monstrous barrel of a head on it. And the guy was like so strong, instead of like using the bat normally, he'd have his hand like down over like the knob at the end, so his hand was like off the bat to try to even get more leverage. And he'd like swing that thing around like a toothpick. Me, I'm like using like a 26. I went down to the little league bats. I got this little one here, and I just like swing really, really fast. But he was like this monster. He'd like whip the bat around. So anyway, like my coach would always tell me, James, choke up on the bat. If you can't like swing the big bat like a normal adult, you know, go ahead and like choke up on it a little bit. So I'm using that concept. Like if you can't do the 5K one and you can't hit the numbers for tonight, then kind of choke up on the bat. Maybe you do like a little lower price property. Like we're using 320 tonight, but you know, maybe you need to improve your defense, do some budgeting, reduce expenses. Like Brian teaches a class on how to like do a side hustle. Maybe you need to do a side hustle and kind of improve your income that way or whatever it is. But those types of ideas. Or house hack. And if you don't know what house hacking is, come to the class we've got here in like a couple weeks. Does that make sense? Okay. Did I go crazy with the like choke up on the bat? Anyone else, like the coach tell them choke up on the bat?
How many donuts do you have?
What? Donuts?
We all believe you had donuts again tonight.
I didn't. Am I jacked up tonight? Really?
You just got jacked up. Skip
Oh,
the
man.
intros, got jacked up on the bat spot.
I don't know.
Down to 80.
Really? Man, I tell you, I cannot listen to myself at 2 times speed. I'm too fast for myself. It's crazy. The good news is I like know what I'm gonna say. I like hear it, and I'm like, oh, I'm going there. Most of the time. Sometimes I don't. Oh man, you're right. I'm gonna slow down, take a breath. All right. So this is where I start talking to you about the household income thing, because and literally this is like why I don't go on Facebook anymore. I'm like super sensitive. And so if someone says to me, James, you know, people don't make $5,000 a month, I'm like, okay, fine, I'll just go off Facebook. I'm not gonna talk to you anymore. So median household income for 2016. I went and I looked up stats. Why is that so funny? It's like true.
Most people just block the haters, not just delete their Facebook.
Oh, I don't. Well, I delete my Facebook. I didn't delete theirs. I just like said, screw it. Screw it. I'm not going on there anymore. Okay. So what is the median U.S. household income? So the U.S. median household income is $57,617 as of 2016. So what median means is that half the people in the United States, half the households in the United States make more than $57,617, and half of them make less. So when I wrote the book, I was thinking this is for the people, this is basically for half of the population. Anyone who makes more than this $57,617. Okay? What is Colorado? Any guesses on what the median household income in Colorado is? Mike? 72. Did you like go listen to the presentation ahead of time? It is 65,685. That's what the median household income in Colorado in 2016 was. So that's where I got that number from. What is Denver? Anyone know? 75,000 is the guess. Denver, Aurora, Lakewood Metro is 71,926. So according to these, it's probably more than 50% of the population that I'm covering with the content of this book. And that was the thinking behind it. So after doing some research, I didn't feel as bad, but I still don't go on Facebook anymore. So hourly rate to earn 60K. So what I started thinking is, how much does someone need to make per hour, a family of 2? How much does a family of 2 need to make per hour in order to earn $60,000? Does anyone want to guess? $15 an hour each. How many of you believe that? Yep, so let's go through it. The book and the presentation were based on $5,000 per month. To earn $5,000 per month, that's $60,000 per year. Assume you and your spouse work 40-hour work week, 40 hours times 2 people, 50 weeks a year. I assumed you took 2 weeks off for vacation, equals 4,000 hours. 60,000 divided by 4,000 hours is $15 per hour. So if you and your spouse make $15 per hour, and you work 40 hours a week for 50 weeks, you make $60,000 a year. Okay? 60-hour work week. How many people in here work more than 40 hours a week? Yeah, me too. So is it reasonable to think that somebody might work 60-hour work weeks, especially if they're hustling to kind of save for retirement and get this stuff done? I would think so. So if you work a 60-hour work week, 60 hours times 2 people times 50 weeks equals 6,000 hours. $60,000 divided by $6,000 or 6,000 hours is $10 an hour. Walmart and Qdoba pay $10 an hour. So anyone who is literally working at entry-level jobs, Walmart and Qdoba, can go and make $60,000 a year if the two of them are willing to work and hustle. It's more than that for Walmart and Qdoba? Well, there you go. Make my point for me. So you can work less than 60 hours, you work 59.
Average in 2018, the average median income is like almost.
So the median in 2018 was 62,000. Okay, awesome. So Brian's going to update my classes as I teach them real time now. So that's good. Thank you for doing that. Okay, so inflation. So when I do the modeling tonight, I'm going to talk about inflation because we're going to talk about inflated dollars and how $8 million 40 years from now is not really $8 million and stuff like that. But in order to be fair, I need to take into account inflation on all your income and expenses and how much you're saving as well. Because it's not fair for you to say, I'm earning $5,000 and I'm going to be earning $5,000 40 years from now if we're going to say, your living expenses in the future are much higher as well. So is it reasonable to assume you'll get 3% raise per year? Anecdotally, 60 hours a week at $10 per hour. Oh, I know what it was. So I'm asking, is it reasonable that you're able to get a 3% raise? Even if you're working minimum wage, you should be improving your skills, looking for better paying jobs, doing side hustles or things like that. So anecdotally, yes, you should be able to get a 3% cost of living raises and kind of keep pace with inflation for that. And that's kind of what I was talking about there. More mathematically backed data suggests 3% per year is reasonable based on the Consumer Price Index. CPI is a measure of how your government assumes what inflation is. And so it goes back and it shows you what the inflation rate has been historically. And this is the website for them if you want to go look at how they calculate it and what it's been. But I went back and I looked at data to see how wages have tracked with inflation over time. And this is what it looks like. Between 1929 and 2018, the average inflation rate was 3.1% per year. The median was 2.7. So I'm using 3% in the book. Does that seem reasonable to you guys? Okay. You can do your own calculations on this particular website if you want to. You can go look back and see what it is. If we look at the historical median inflation adjusted earnings in the U.S. according to the U.S. Census, we can look at that chart here on the next slide. Your wages are likely to increase with inflation about 3% per year, but your buying power is likely to remain the same. So you're going to see me show that your income is increasing, but your buying power, your standard of living is going to remain constant. We're not saying you're increasing your standard of living. So whatever standard of living you're living at now, if you're getting 3% inflation adjusted raises, you're staying at that level. Does that make sense to everybody? Okay. Is it hot in here or is it just me going crazy with all my sugar?
It's just you.
Okay. Okay. All right, so here's a chart. And I used, this shows you what the inflation adjusted median earnings is going all the way back to 1960. This is 1960 over here, and this is 2016 on the side. So you can see that the inflation adjusted median earnings is increased where it stayed relatively constant at about $50,000 per year. That's what it shows here for the inflation adjusted number for males. That's what the male earning power has been. Females, I went and I looked at the chart, it was not the same because there was a significant increase over time for females. So I wanted to show you that males actually have held steady, although the female one's been increasing. Does that make sense? Okay. So according to this chart, we are seeing wages keep pace with inflation, about 3% per year. Okay. All right, so let's talk about scenarios and story time. So now I'm going to tell you basically some stories about different situations or different scenarios that people go through and like what it looks like if they operated and did this particular scenario. So the first one we're going to cover is saving $160 a month. So someone's making $5,000. They are saving $160 a month of their $5,000 per month income. And they do not own any property. They are renting. They're living in a rental property and they're not owning any property. They start with $5,000 in savings. I just arbitrarily picked that so that everyone is the same. So we say you're starting with $5,000 in savings. You're making $5,000 a month. You're saving $160 a month. And this adjusts for inflation as you get raises. So your income, $5,000 a month, increases with 3% per year with inflation. Your expenses increases 3% per year with inflation. And the amount you're saving, $160 a month, increases 3% per year with inflation. Does everyone follow that? Because Royce is going to challenge my math here in about 3 slides, and he's not even paying attention to know that he's going to be challenging it.
Zero labor statistics right now.
Okay, you're checking on it? Okay. So what happens if you don't invest in the stock market? You just take this $160 a month and you stick it in a mattress. Does anyone have any relatives that actually stuck money in the mattress? Just my crazy family? Wow, okay. I don't know, this is like, I don't know how I feel about that actually. Really, like there's no other ones that like their crazy aunt or father-in-law. Oh, you did. You had a crazy aunt that did it? Okay, that literally, Vaseline jar. Yeah. I'll tell you like a side story. So I know I'm on the mic. I'm going to tell the story somewhat secretly. A close relative of mine, I won't say who it is, I must have distrusted banks or something like that, but they would have stacks of money, $100 bills, along the inside edge of their closet door. So like if you went in their closet and you put your hand up there, you could take down a stack of like, $10,000 or whatever it is and just pull it off the thing. That's where they stored the money. They didn't like banks. Well, apparently I'm the only crazy one. That's really weird. Okay. So what would happen though if someone made $160 a month, saved $160 a month, and they did not put it in the stock market, did not save it. They just put it in the mattress. How much would they have? They end up saving about $151,000 over 40 years. And that's in inflated dollars. Royce or Brian, whatever, one of you guys, would you multiply 1.03 raised to the 40th power so we can figure out what the multiplier is to adjust back to today's dollars, please?
40?
40 years, yeah. So almost 3. So if you take this number and you divide by 3, you get an approximate value of what this is in today's dollars. So it's like having $50,000 in today's dollars if you don't invest in the stock market. Can you guys retire on $50,000 in savings? Anyone? Yeah, problematic, right? So probably not enough to retire. And what if you can't save $160 a month? Because I think that was one of the challenges. Once I got slammed on Facebook, I said, okay, let me deal with all the people saying I can't save $160. So if you can't save $160, you should be seeking out knowledge on how to do the real estate stuff. You're seeking out knowledge how to do the real estate stuff. Seek out knowledge on how to save money. Focus on increasing your financial education, budgeting, reducing expenses, increasing income, self-improvement, and side hustles. Like Brian does a class where he teaches Amazon side business. What do you think reasonably someone can make from a side business? Amazon side business.
Are you asking me?
Yeah, I'm asking you.
5K a month.
So Brian said 5K a month, which kind of destroys this whole presentation because it's 5K a month. So like, what do you think someone can do like part-time Amazon side hustle easily? 5K a month. Okay.
I mean, if you only wanted to work, what, 10 hours?
Yeah, let's say 10 hours.
I mean, you can make 1K a month.
$1,000 a month. So you can easily save $160 a month for that.
Yeah, if you focused on the class, it would take you 6 months to ramp up to that, but you could get there pretty quick.
Okay, so you could do that. So read books, listen to podcasts. The Amazon side hustle thing is available on the podcast. That is staying up. It's like our Brian's gift to you. So read stuff online, whatever it takes to build your skills to be able to save more money, and there. So let's go change the story now. So the story before was he saves she saves $160 a month, actually family, and they do not invest in the stock market. They just put it into their mattress. What happens if someone saves $160 a month, but now they invest in stocks? What do you think? What do you think is going to happen?
They'll make more.
A lot more money. How much more?
8%.
Well, let's do that. So they're still renting. They don't own any property. They start with $5,000 in savings. They save $100 per month. It adjusts for inflation as they get raises, so it increases. It's not $160 a month 5 years from now. It's $160 plus 1.03 raised to the fifth or whatever it is. and they invest in the stock market. They get 8% per year in the stock market. And when I said 8% per year, how many people said, oh, James, this is crazy. 8% is way too high. How many people thought that 8% was way too high? Okay, so you're welcome to go change whatever numbers you want in the calculator and do the math again. How many people think it should have been higher? No one? Okay, so 8% is optimistic. If they get 8% per year in the stock market, that's what we do. The stock market returns may vary, although we assume they did not in the majority of cases here, although I'll show you some Monte Carlo stuff here shortly. Let's look at what Monte Carlo simulations are. So if they did this $160 a month and they invested in stocks, this is what it might look like. All right, instead of using 8% return, we used a random return between -20 and +36. So if you go pull the stock market data, I think I used VT-SMX, which is the entire stock market index. I went back to 1871 to 2018, and I pulled the data, and the range of values was a little bit more than this, but I kind of narrowed it in to make the math a little easier. -20%, so you have years where it was pretty negative, -20%, all the way up to years where you have +36, but the median, the middlemost number, was still that 8% number. Does everyone follow what I just said? There are some years where the stock market goes down. Does everyone agree with that? There are some years where the stock market goes up. Does everyone agree with that? The average over a very long period of time, in this case the median, is 8%. Everyone follow? So we just did this. Median historical return is this. About 65% of the returns are between 0 and 16. So most of the returns are kind of clustered in this 0% return to 16% return. Some years there are really extremes where it goes up a lot, and there's some years where it actually goes down a lot. Everyone follow? Okay. So if we graphed 5,000 of these returns, what is the frequency that they occur? It might look like this. Okay? And I'll talk to you what is going on this chart. So this is on the left-hand side, this is the value of the return. The 8% average is right about here or so. Each one of these dots is an example of a return run. So basically it says the return for this dot was, I don't know, +20 something. Well, the return for this was, +8. The one for here was probably -15 or so. But each one of these dots is an example of return. This curve shows you how many times those ranges happen. So how many times did we get 8% return? Looks like of 5,000 runs, we had about 170 of them or so. So this shows you the frequency, how frequently the returns happened. That became a bell curve, and that's what we're talking about. Does everyone follow? I'm not going to make you do hardcore math, but I want you to get the idea that most of the returns are around this 8% range. Cool? Okay. So using that range of stock market returns, what does the yearly rate of return look like? And then what does that do to our net return? So yearly rate of return, this shows you of the first run I did, what the returns were, so you can see the actual math. There are some years where it's negative. There are a lot of years where it's kind of like around 8%. And there's some years where it's really positive. And if we use this, this is what our net worth looked like. We started off with $5,000. We invested $160 a month. And sometimes the stock market went up a lot. Sometimes it went down a little bit. This is where it went down. It shows you if you just did this in one example of a run, you made a little less than $800,000 investing in the stock market. Now that's 40 years in the future. What is that in today's numbers? About 1/3 of that. So about $250,000. So if you saved $160 a month in the stock market, what would you be able to retire on? About $250,000. Could you live on $250,000 in retirement? For a short while, yes, that is true. Okay? So what if we ran this again? Because the stock market return is random. Returns will be random again for each month. Some months will go faster. Some months will see the same. We'll see our account decline, negative return. How might this impact our account balance? And then no real estate in our account means the account balance is our net worth. So it's only the stock market right at this point. This is doing it twice. Again, random return numbers. So you can see that one is actually now a little higher. You're over, I'm sorry, this was the first one. This is the second one now. So it's a little bit lower. So you had a couple of years in here where you had negative returns or break-even returns. Okay? That's running it twice. If we ran it a third time, it might look like this. You can see it starts to give you a little range. If we ran it 4 times, it looks like this. If we ran it 10 times, it might look like this, where you have this range of values. This is like the best case of the 10 runs. This is the worst case of the 10 runs. But you can see about where you might end up with some kind of distribution ranges. Does everyone follow? Okay. So here's 100 times summarized. Monte Carlo allows us to run a large number of these cases and then summarize them. 100 runs, and then we look at them and we say, what was the best case? Like, what was the best run of 100? What was the worst case? What was the lowest one of the 100? Or we could say crazy things like, half the time we made this or more, or half the time we made this or a little bit less, or you could say probabilistically that 75% of the time I end up with X dollars or more for these 100 runs. That's where we're going with some of the Monte Carlo stuff, okay? Or 25% of the time I end up with Y or less. So here's a chart summarizing the yearly rates of return with 100 runs. So this is just showing you all those rates of return. They're kind of hovering around this 8% for the median, but there are some times where you have really high returns, sometimes where you have really low ones, but as you get toward the middle, you have more frequency of returns there. Does everyone follow? Okay. So here's your net worth if you ran it 100 times. This shows you every time we started with 5,000, and then our returns became variable. And so you have this range of returns here at the end, where you have a really high return in one example, a really low return in another one. This is your median, that really dark line. And then you can see there's a lot more frequency. You tend to get a lot more of your results hovering around this median. Everybody with me? Okay. So this converts to this when we summarize it. You take all these individual lines and they become this kind of like chart showing you how many happen within narrow bands. Okay? Okay. So this is a zoom in showing you this is the 1%. So one of your 100 runs that you did end up having a net worth of about, whatever that is, $625,000. This one here is one run where you were really high, and that shows you have about $925,000. This is the 5% range. This is the 95th percentile. This is the 5th percentile. This is the 10th percentile. This is the 90th percentile. This is the 25 and 75, and then this is the 40, 60, and the dotted line is your median. So this says half the time you made about $750,000 or more, or $750,000 or less doing these runs. Does that make sense? Okay, so it's this range of values. All right. So saving $160 a month with stocks, if it's a fixed 8% return, you'd have $848,000. That's if the returns were all static. If you do Monte Carlo, 80% of the time, it would be between $685 and $878. Again, these are future dollars, so divide by 3 if you want to know what they are in today's dollars. That's the 10th percentile and the 90th percentile. Half the time, it will be better than 768, and half the time, it will be worse. If 1 out of 100, or 1% of the time, it would be either on the low end, 629, or 942. You want to improve your odds, like if you don't like where these numbers are and you really do want to do the stock market savings plan, save more money than 160, or select better investments, or reduce risk by selecting investments with a narrower range of returns, or select more profitable investments. Now we're going to switch over to real estate about halfway through the class. Is everyone ready? Okay. All right, how many people come to my deal alchemy class where I manipulate the crap out of this quadrant? Right? Okay. So you guys are familiar with this quadrant then. It shows you the 4 different areas of return you get by investing in real estate. Appreciation, the tendency for property values to increase over time. Usually it's from inflation. Cash flow, the amount of money you get after you subtract all your expenses on the property. You get rent coming in, you subtract all your expenses, whatever's left over is cash flow. Debt pay down, it's the return you get from paying down the loan. Okay, it's not cash flow. Cash flow is already accounted for here. This is the amount of principal you're paying down on the loan each month. And then you have tax benefits of depreciation. Okay? And so we go into this a ton in like the deal alchemy class, and this is more in the new book, Fire book or whatever it is, but this is what we're going to talk about a little bit here. What I'm going to talk about first, is just debt pay down. So debt pay down. With traditional amortizing loans, this works. If you have an interest only, what is your debt pay down return? 0, because you're not paying any principal on it. It's interest only. Okay. So as you make monthly payments, a portion of that payment pays off the amount that you owe. You guys know when you get a 30-year loan, you make a payment, the amount that you owe on the loan goes down, correct? You owe less the next month. And each month that you do that, it continues to go down. Do you know that the amount you pay down each month actually increases over time? Are you guys familiar with that? So that the amount you're paying in principal later in the loan is greater than the amount you're paying in principal per payment early on in the loan. You guys familiar with that idea? Okay. So you owe a little bit less after each payment you make. This is the amortization table you typically sign to closing. Have you been to a closing? And you had a sheet that has, or 6 sheets that have all like the amortization table. This is how much you're paying for your monthly payment. This is how much your principal is. This is how much your interest is. This is what your then mortgage balance is. You guys get that sheet? You had to initial it?
That's the one you're supposed to review all the lines because they make mistakes in it.
They do not make mistakes in it, but that's very good though. Yes. Okay, so you get that when you get closing when you buy a house. So this is the amortization table you get. The amount of loan you pay off with each payment increases over time. So if you like to think about this, I'm going to set up the math problem and show you what the return you're getting from debt paydown is, and I want to compare it then to what return you're getting in the stock market. Okay? So this is like a black box. You start off with a down payment, some magical black box stuff happens here, and you end up with a paid off house. I don't know what is so funny in the back of the room, but apparently, did I say something wrong? Okay. So you start off with a down payment, you have this black box, and then you get a paid off house at the end. Okay? So here's what happened. In the $300,000 house, you put in $60,000, a whole bunch of magical stuff happens over 30 years, and you end up with a $300,000 house at the end. I don't know what is so funny back there. Okay. Okay, so that's what you got going on.
Return of the black box as finally returned.
What's that?
You like the black box. It's like been a thing since we've met.
Really, the black box?
It's like a black box. What if you had this much money and you get this much money out the other side? Do you care what happens to the black box?
I think I told you that when we first met.
Yeah.
Yeah. Okay. Okay, so anyway. So this is the formula for actually calculating the return on this. I'm not going to go into crazy detail. This is the end value of the property, whatever it is, $300,000. This is the amount you start with, or $60,000. 1 plus the interest rate, which we don't know. We don't know what the rate of return is, over the time, 30 years. And then you multiply by, or the number of times interest compounded per year, actually in this case 12. And then number of times per year times the number of times you're compounding. Okay? So if we want to solve for what is the rate, because I want to find out if we're sticking $60,000 as a down payment into a property and we end up with a free and clear property for $300,000 at the end, what is the rate of return we're getting on $60,000? That's what I'm asking. What do you think it is? What value, what rate of return are you getting if you put $60,000 in a property and you end up with a $300,000 asset 30 years later? Brian says 5.51. Let's see if he's right. So we'll start off with $300,000. 60,000 times 1 plus r raised to the 30. We assume we're compounding interest once per year. And actually, in the last class, Royce went and checked and did monthly compounding and found out it's basically the same number. So you solve for the rate to figure out the rate you'll need to get in. Take your $60,000 down payment, have it be worth $300,000 by year 30. Appreciation is totally different. So someone asked me before, so James, you're trying to say the house is still worth $300,000 30 years in the future? No, but where is that return calculated? In appreciation. So this is the only debt paydown return. So we're assuming you're starting with the same balance, a $300,000 house. So yeah, the house does not need to go up in value for you to get this return. It doesn't matter if the market goes up or down here. We're calculating that return elsewhere. Everyone follow? Okay. So what is the rate? Brian says 5.5. 5.51. It depends. Turns out the rate varies depending on the down payment percentage, and therefore the amount, and the term of the loan. So you do a 30-year loan, it's going to be a different rate of return than it is in a 15-year loan. And that makes sense, right? You put $60,000 in, and you end up with a $300,000 house. It matters whether we're talking about that over a 30-year period, over a 15-year period, over 20, over 10, whatever it is. Does that make sense? Okay. And if you're selling before the full term of the loan, the interest rate also matters. So if you're actually going to go buy a property, if you wouldn't mind checking in, thank you. You're going to buy a property, you're going to put $50,000 or $60,000 down, you end up with a $300,000 property. If you're not waiting till the loan is paid off, when you sell is actually impacted by the interest rate. Like the return you get is impacted by interest rate. If you have a higher interest rate, your curve for the payoff part of this varies. You checking my math? Okay. Okay, so if you go to full term or loan, though, it doesn't matter. So if you're going out full 30 years, it doesn't matter if you have a 12% loan, or you have a 3% loan, or you have a 1% loan. It doesn't matter. The rate of return for the entire period is exactly the same because you went from $60,000 to $300,000. No matter what the interest rate is, it doesn't matter anymore. But if you sell it, the amount you have paid off actually impacts that. Does everyone follow that really weird, twisted math? Okay. So let's take a look at some stuff. Let's see the ROI, the return on investment, for various down payments and terms. And here's an amazing chart. So if you went and you got a 5% down loan and you got a 30-year term on it, you did Nomad, you put 5% down and you put in $15,000 and you ended up with a $300,000 property at the end of 30 years, you ended up getting a 10.501% return on that money, on your down payment. What did we get in the stock market? 8, if you're lucky. What's interesting about this return? Does the stock market have to go up in order for you to get that return? Is it market dependent? It is? No, rent is different. Rent is cash flow. So your renter actually has an impact elsewhere. It's taken into account in cash flow. So you could have a negative return in cash flow. This is just debt pay down, right? Because those are like appreciation, the market going up or down is appreciation. Whether you're getting the cash flow in order to support the property is in cash flow, and then your tax benefits are elsewhere. This is just debt pay down. So the return you're getting there is this. And let's assume between the other three, it's break even. Okay, let's assume for a second that appreciation and cash flow and your tax benefits are all break even. So maybe you have negative cash flow. And if you do that, just kind of pretend that for a second, this is just debt pay down return. So does this matter what the stock market is doing? Are you getting this return if the stock market goes up? Are you getting this return if the stock market goes down? Yes. This is a return you're getting based on debt pay down. Okay? So it doesn't matter. It's like one of the most guaranteed types of returns without being guaranteed you can. If you make your monthly payment, you get this return. So as long as you make your payment on your loan, you're getting this return. Okay? So in this case, you're getting 10.501 if you put 5% down on the property. Is that better than the stock market? Yes. What if you did an FHA loan? That's the green one here. It's 11.823% return on your money. You put less down. What if you put 20% down? That's this red one right here. That's 5.51% return on your money. What if you put 20% down but you did a 15-year loan? That's this one right here, 11.326% return. So if you do a 15-year loan with 20% down, you're getting 11.326% return on your money from debt pay down alone. Does everyone follow this? Is it kind of crazy? Has anyone here done a 3% down loan for their first Nomad property? A couple. So 3% down is right here. That's 12.399%. Is anyone fortunate enough to be able to do the 1% down loan for the Nomad property? You did 0? So 0 is infinite. But the 1% down loan program is crazy. It's 16.591. That loan program is no longer available. The 3% one is, and the 5% down ones are. Okay? Is this kind of cool? The return you're getting? All right. So now that I showed you the return you're getting just from debt pay down, what do you think happens when we add real estate to this person's kind of equation? Probably comes interesting. Yeah. So this is some math. If you decide to pay it off before the loan is paid in full, you can see this is the balance you have, and this shows you the ROI if you sold it in that year. One thing I'll point out is this is a 20% down one. 5.51 for the entire duration, but it's higher in the beginning. So you have 6.45% is the return on investment you're getting if you sell it earlier. Okay? So you end up getting a higher return on investment number earlier on in your debt pay down thing. If you sell it. Okay. All right, so this person basically says, just buy one house and invest in stocks. So we're not even going to start with investing in property and getting rental property. We're just going to say, person buys a house to live in. How much of an impact does someone buying a house to live in have on their net worth and their ability to kind of retire? Let's take a look at what the numbers say. So they're doing a nothing down rental. How many people think you can't do nothing down in our market right now? Anyone? So there are 4 nothing down loan programs that I know of right now. USDA, you can buy properties in rural areas. Windsor qualifies, Wellington qualifies, and some small parts of Greeley qualify. There's probably some other ones like Johnstown that probably qualify too, although I don't know that one for sure. VA loan, how many people are veterans in here and get VA loans? No veterans? Oh, they're all celebrating for Memorial Day. So veterans can get a 0% down loan, and then there are 2 local banks. I think KeyBank does a 0% down owner-occupant loan, and I think Compass Bank does a 0% down owner-occupant loan. So those are the 4 different loan programs you can do 0% down, and they're usually like you can only do 1. After that, you're probably doing 5%. So they're going to do 1%. They're going to go buy a property, move to Windsor, wherever they're going. They're going to be my neighbor in Windsor when I move there, and they just live in it. No rentals. Okay? They take fixes a large part of your living expenses, principal and interest. So in our model, we assume that their expenses were going up by 3% per year. When you have a mortgage, your principal and interest part of your mortgage on a 30-year amortizing loan is fixed. It does not go up with inflation. Taxes go up with inflation. Insurance goes up with inflation. Maintenance goes up with inflation. But a big percentage of your expenses, your payment on there, they do not. They become fixed. Okay? So if you basically look at this, we're fixing a large percentage of this. They're still saving $160 per month, and that's increasing with inflation. In fact, it's increasing faster because their expenses, we're going to assume that they take the difference between what they would have saved by not having their rent go up, and we're also going to invest that as well. And that's a really key part to understand. So they're saving $160 per month. They're investing in the stock market. It increases with inflation and with fixed majority of housing expense. So because their rent isn't going up by 3% a year anymore, their payment, they're able to save more money by living in a house. Does that make sense? Did everyone miss that? Because that's a really key part. You're going to see it here in a second. Anyone miss it? Awesome. So invest your saving for housing saving as well. Without a house, but investing $160 per month in stocks, you had $848,000 at 40 years. That was from before. How much do you think you have by adding a single house you live in? Where do you think it goes from? You were at $848,000 before. How much do you think you have if you add a single house to live in? 1.3, 2.5, 1.5. Let's see. So you just buy the one house, invest in stocks. And I will give you a hint if you want to change your answers. A $320,000 house growing at 3% per year over 40 years is worth $1.04 million by itself. So that $320,000 house, just from inflation, 3% appreciation each year, becomes $1.04 million by itself. Does that change anyone's numbers? What is it now? 2.5? What else? 3.5. So let's look at the amount saved for a renter and homeowner. So if you're renting, you start off by saving about $160 a month, and this is just that 3% inflation. So it's increasing, 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 so that by the time you get to the end in year 40, you're saving just over $500 a month. What do we say here? How do we just back for today's dollars? We divide by 3. So what's like $510 or so divided by 3? About 160, right? So you can see we're not really changing anything. It's the same standard of living. You're saving the same amount of money. It's just increasing with inflation. This is for someone renting. If we adjust for inflation, it shows you it's at the static 160 per month. That's what it's showing you there. That's why it's flatlined. Everyone follow? Okay. This is what it looks like when you own a house. So there's a peak at the beginning. Why is there a peak at the beginning? You get a free month. So when you go buy a house, interest is charged in arrears. So the first month that you live in a house, you have to live there, and then on, let's say you move in January 1st. February 1st, they look back and they say, you now lived in this house for a month, let's charge you the interest. The interest is now due on February 1st for you living there in January. Now, they catch up at the end. If you were going to go sell the house, they're going to charge you a full month's interest the day you sell, even though you're not living in that house for the next month. So they get it back at the end, but in this case, because the first month we move in, you actually do get a little bump. And it works out to be about, I don't know, 2,000 and change. Okay? Then it drops back down to 160. Then it's increasing, but it's increasing faster than just inflation though. What happens here? The house is paid off. So now all of a sudden, you're not saving just $160 a month anymore. You're saving $4,500. 30 years later, you're able to save a lot more because you no longer have a house payment. You still have taxes, you still have insurance, you still have maintenance, but your principal and interest part of your payment is gone. Make sense? And then from here on, it just increases a little bit. Now, what if we adjust this for inflation? This is the 160 if you were just a renter. If you adjust for inflation, though, it shows you have a big peak, but then it's still increasing. And it's increasing more because your mortgage payment, your principal and interest payment is not going up. And so this is the difference between what rent would have been increasing to and your mortgage payment going up, okay? And so over here, this is when it pays it off, and then it goes up slower because you no longer have that increase from rent. It's just your taxes and insurance then. Okay? Everyone understand? Nice. Brought your chair. Any questions on this? Okay. So if we do that, you just buy one house, you invest in stocks. So how much do you think you have by adding a single house you live in? Without a house, but investing 160 a month, it was 848. Remember that the house adds about $1 million by itself. Plus now you see that there's added savings from being a homeowner invested at 8%, because you're taking all that extra money that you were able to save on that, and now you're saving and investing that as well. This makes a huge difference. You go from saving $160 a month to saving almost $1,900 a month in today's dollars once your house is paid off. That's huge, right? Turns out your net worth is $4.68 million in year 40. $4.68 million. It requires the discipline, though, to invest the original 160 and all the extra savings. You cannot let your standard of living creep impact you. You got to take that extra and save it, which is a big deal. Yeah, Mike, you have a question? Microphone?
You said you were factoring in the savings that someone would have because their rent is no longer going up.
Yeah, because your principal and interest part of your payment is fixed.
But do you factor in that when they first move in, it could be that their payment is higher than what their rent is?
In this case, I didn't, although I do that calculation in other presentations.
Does it start the same in this calculation?
Yes.
Okay.
We assume you're buying a house where your payments is exactly the same, so that you're still saving that $160 a month. You find a property that you can live in that has the exact same characteristics. So it's got to be a property that you can buy for the same price that your rent would have been originally. Make sense? That's a good question. So now let's talk about different scenarios. So we talked about someone just going and buying a house, moving in, and not doing any rentals. What if you add one rental? What does that look like? So you buy your personal house with 0% down, you live there and you stay there. That's the same as the last time. We're going to invest our $160 per month. We're growing the savings. We're investing in stocks until when we finally have enough for a 20% down payment property, we take out the money from the stock market and we buy a 20% down rental. You don't need to Nomad to move into this. So you're buying a non-owner occupant property, putting 20% down, and you're doing that property that way. So we have the nothing down loan program that we bought where we live in, and then it takes us just over 10 years to save up a 20% down payment because the property values are going up. So you're having to catch a moving target. The property values are becoming more expensive, so you have to save 20% of the higher priced property. Then we finally buy a 20% property, and that's all we buy. Is everyone follow this one? Okay. So this is our account balance. We start off with about $5,000. It continues to increase. Then we have enough money for the 20% down payment. We pay it, and then it continues saving up again. This is the drop-off I just showed you. This is the drop-off. It's right here. Okay? So this is the rest of the chart. Then you just continue to accumulate money in your account for the rest of the time. Everyone get it? Okay. So what's the cash flow when we buy this 20% down property? In this particular case, we bought the property so you get that free month of rent. You don't have a mortgage payment, but you're getting rent on the property. But then it's negative. And this is already taking into account the depreciation benefit. So we're assuming you have negative cash flow on this property for whatever it is, 3 years or so. And then it finally goes positive and starts increasing. That's buying a property with 20% down. Okay, so this is a property that if you put 20% down, it would have negative cash flow. Everyone follow? And then this is what it continues. And it continues to increase over time as rents continue to go up and you've locked in your mortgage payment. What happens here? That's right, you lose your depreciation benefit. You've owned the property for 27 and a half years. You no longer get the depreciation benefit, and so it goes here. Why don't we see a drop off or an increase in rent because the property's been paid off? Because it happens off the chart. What's it?
No rent is going to pay you extra because you paid it.
We're getting more rent though, net rent. All right, anyway. So basically, because we bought the property beyond year 10, beyond month 120, we don't actually see when the property gets paid off and we no longer have a mortgage payment. It happens beyond 480 months. Okay? So after 40 years without a house, but investing 160, we had $848,000. With a single house you live in and investing in the savings, you had a net worth of $4.68 million. What does adding one rental do for you? We discussed cash flow. That's about $1,800 a month, and it improves when the rental is paid off, which is beyond 40 years. But what happens to net worth? How much does your net worth change? You had 4.68 if you just had the one property. What does adding a single 20% down rental by saving up for 10 years do? How much does it impact your net worth? No one's like, everyone's afraid to guess because they've been wrong. 7.5. Net worth with one rental and saving 8% in stock market is 5.38. So acquiring a rental about 10 years in adds almost $1 million and some extra cash flow to your portfolio. Interesting? Okay. So what if you say, by the way, every time I teach Nomad, inevitably, they come up to me after class, they're like, James, I love the Nomad model, and I would love to do it. It would be amazing for me. It's like this amazing plan. But you know something? My spouse won't go along with it. My spouse will not move every year, right? I mean, how many times have I heard that? And the spouse isn't the one here, by the way. They never come to class. Okay? So what if you can convince your spouse to do it once? Not like 10 times, but honey, let's move one time. It's what I'm working on with my wife right now. Let's move one time. Let's see how it goes. Okay? So, if you do this, you nomad into the second property instead of doing 20% down. How does that look? Instead of waiting until we save up 20%, the 10 years, what if we moved once? We only now need to save up 5%. How does that affect when we can buy our next property? Before, it took us about 10 years to save up 20%. This is what it was when we did the 20%. It took us that long. This is how long it takes us to save up 5% down. So we get our rental in month 30 instead of month 128. So what impact will be able to buy your first rental 30 months in instead of 128 months in? Is it going to have a big impact? Yeah, I think so too. So let's see what happens. So this was our cash flow before with the 20% down. This is our new cash flow. So we had no cash flow while we were living in the property. When we converted it to a rental, it's negative. And I will tell you, it's more negative than the 20% down one was. Why? Why do we have more negative cash flow when we nomad into a property? You put less down. In this case, we put 0 down, right? But our interest rate's probably a little bit better, although I don't think I actually changed the interest rate in this one. But you would have a little bit better interest rate, so probably a little bit better than this. But you're actually going to have 0% down instead of 20% down. So it's negative. You're feeding this property for a while. Okay? Whoops. This shows you the difference. So this is where you bought it before. This is when you converted it to a rental, one that you were already living in. What's interesting here though is when you if you were going to buy your 20% property, you would have more negative cash flow from the 20% down property because you waited longer than you would have on a 0% down Nomad property that you bought earlier. Is that interesting? You actually end up making better cash flow on the property if you had nomaded. And then it continues to outpace the 20% down for a little while, and then something magical happens because now you actually pay off the property earlier. And so your cash flow bumps up even sooner. We can't see it on here because it's off the chart when you pay off the 20%. Does that make sense to everybody? Crazy? Okay. So now you nomad your second property instead of 20% down. So buying the rental earlier as a nomad, we showed the difference in cash flow. How does that impact net worth? With the buying the property, living there, and buying a 20% down non-owner occupant property, it was $5.38 million in year 40. What do you think it's going to be when you do the Nomad once? And all you have to do is convince your spouse one time, honey. One time we can move into this property. That's it. $8 million. Any other guesses? 6.5 million. Net worth by doing this Nomad is $5.98 million in year 40. It's about $600,000 better. Yeah, Mike. Royce, microphone.
So in this scenario, it's the second property you bought with 0% down.
Nope, the second one was 5% down.
Oh, okay. 'Cause that was my question. Can you do two at 0? I know USDA you can only do one VA, but I was going to ask.
You can do more than one VA, but it's up to your VA limit.
But will Key Bank or Compass Bank do if you have another?
I don't think so.
Okay.
I think it's a one-time deal. I think you have a good chance of getting 0% down loan. Yeah.
And you're saying with all the extra cash flow, you're investing that extra money back into the stock market at the 8%.
Yep, that's correct in this case. Yeah. Yep. Okay. But who likes moving? Even if it means $600K in improved cash flow later, long after the pain of moving is forgotten, what if we forego nomading and we just buy as many 20% down rentals as we could possibly save for? What if we went crazy? We said, let's go build a 20% down rental empire. What happens then? So instead of stopping at one 20% down rental, we buy another 20% down as soon as we have the down payment. We reserve $5,000 in a cash buffer. We adjust up for inflation, so it's not just 5,000, it's 5,000 plus whatever the inflated 5,000 is in the future. How many rentals do you think we acquire, and how quickly do we acquire them? Over a 40-year period, how many rentals, 20% down rentals, can we acquire doing this model? What do you think? 6, 5, 4. Let's take a look. So this is before when we bought the 1. This is what it looks like when we buy as many as we can. So you still buy the 1. Then you're able to buy the second one around month 200. Then the next one around 260. And then we get faster as our cash flow improves and the amount we're saving improves. We eventually get to the point where you have 12 rentals. 12 properties total, I should say. 11 rentals. This is the one that we bought one. We just kept it. It's the blue line, just so you can see it. Any questions on that? 12 properties, 11 of them rentals. Okay, so this is the account balances. This is when we bought that 20% down rental. This is what it looks like when we're saving up and we're doing the down payments. So we save up, we buy one. 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 We save up, we buy one, and so on and so forth. It just keeps zigzagging, and we never accumulate money in our bank account because we're always using the money for down payments as soon as we get to the point where we have a down payment plus 5K. Everyone follow? So this is just a really aggressive 20% down, pretty traditional investor model. So was it better to take our money and buy 20% down payment rentals or to buy just one rental and invest the rest in the stock market? What do you think? Is it going to be better for us to buy more rentals or better to keep our money in the stock market? Rentals. Remember our discussion of debt paydown. How much better? How much better cash flow? How much better net worth? And then for management, by the way, I did include that you are hiring a property manager, and so you have to manage your manager. You're not managing these yourself. There's a full 10% taken out for that. Okay, let's see what it looks like. Here's your cash flow with just one. There's the peak, and then it kind of increases over time. Remember, it doesn't pay off. Here is the cash flow for the 10 or for the 11 of them. So basically, you buy one, it becomes a little bit negative. You buy your next one, it's still a little bit positive, but it's pretty close to zero. Buy another one, buy another one, buy another one, buy another one, and then your cash flow finally increases such that at the end, it's like $7,500 in future dollars, so about $2,500 today by buying all these rentals. $2,500 passive from buying as many 20% down rentals as you possibly can.
But they're not all paid off.
They're not all paid off. In fact, none of them are paid off. Because by the time we bought the first one, we don't have time to pay these off here. Yep. Okay? This is just the cash flow from buying the one. So you can see what that looks like. So turns out it's about $7,841 compared to just under $2,000 for buying just the 20% down rental. So this is buying however many it was, 11 or 12. I think it was 11 rentals. That's what the difference is. Net worth, it was 5.378 before. Now it's $7.4 million if you buy the 20% down rentals and you save up. Now this is somebody saving $160 a month on $5,000 income. Does that seem pretty reasonable? Basically, Walmart and Qdoba, 60 hours a week. Not bad. Yeah. Where's Mike?
So what about like CapEx expenses?
It's included. We're doing a maintenance reserve in this one.
Okay.
Yeah. And now if you really want to do CapEx, you could increase the number, but you could also take care of CapEx by doing some like lease options and getting creative and selling off your portfolio and turning it. But it does include like a full maintenance reserve. Yeah. Yep. Good question. All right, here's the net worth going through it all. So if you just rent, basically you do the put it in your mattress, really small net worth. If you put in the stocks, you have a little bit larger net worth. If you do a home and you don't buy anything else, but you just invest in the stock market, that's the green bar. If you do one rental with 20% down, that's yellow. And then repeat one time, you do Nomads, a little bit better. And then if you buy as many 20% down rentals as you possibly can, that's the blue one. And that shows you the relative sizes of your net worth for all those different plans. Okay? Maybe I'm willing to Nomad. Maybe. What would that look like? I mean, make a case for me, James. You know, maybe I'm willing to convince my spouse to do it, or maybe I'm willing to jettison my spouse and do it on myself. You know, whatever that ends up being. Maybe. So if you're divorced, we'll do it before you own all the properties. But I mean, you do it before you own the properties, I think you're okay. I mean, this is someone working at Walmart in Qdoba. They had $5,000 in the bank.
Just Just do them on their negative cash flow. So you owe money.
Okay. So what if you're willing to Nomad to acquire a total of 10 properties instead of saving up 20% down payments? What does this look like? How quickly do you acquire properties compared to the 20% down Empire Builder? So this is the speed. You end up buying one right away. Doesn't take you that long to get your first one, your next one rather, your first rental. Next one, next one, next one, next one, next one, next one. Then you stop at 10. You have 9 rentals and 1 that you're living in with this model. So less properties than you have with 20% down. This is the speed if you did the 20%. So this is how long it takes you to get to 20% where you get to this number versus this is the speed if you do it with Nomad. So you end up acquiring properties much quicker. And that would make sense, right? You're only saving up 5% down instead of saving up 20% down. Does that make sense to everybody? This is your account balances. You're saving up for them, doing your down payments, and you're doing that. This is, I think, is the 20% down. This is the 20% down rentals where you're buying more. This is the one for doing Nomad. You save your money, you buy a property, buy a property, buy a property, buy a property, and then we stop buying, and now you invest the rest of it in the stock market. So you end up with some stock market balance as well. You can compare the two. This is the 20% down where you're just saving up and paying it off. And then here's where you stopped buying here and you just start saving for in the stock market from Nomad. You stop buying at 10. Any questions on that? Okay. So cash flow. The monthly net cash flow for the Empire Builder with 11 rentals was $7,841 per month in month 480. Divide by 3, you get about $2,500, $2,600, whatever that worked out to be. That's month 480. How much do you think cash flow from 9 rentals acquired via Nomad will be in month 480? 2 fewer rentals, significantly lower down payment than 20% down, so you'd think cash flow might be a little bit worse, but acquired sooner. So think, some of these houses are paid off. Any ones you bought before like year 10, they're now paid off. How much in cash flow? What do you think? 12,000. 28,000, 10,000. Any other guesses? Here it is. This is 20% down. So this shows you the 20% down one. We're going to kind of compare it. That's like 78 or whatever it is. This is the one for Nomad. So you start off with negative, and then it finally starts growing. You start having houses get paid off, houses get paid off, houses get paid off, such that you have, I don't know, whatever that is, 17,000 or so in cash flow from the Nomad model. Because you did 0% down for the owner occupant, and then you were able to acquire it in month 30, and then it took you a while to save up 5% down for the next one. Okay? And you had negative cash flow, which is hurting you, hurting your saving ability. Okay? So you have those. I think I just won another burrito. All right, so here's the cash flow difference, $17,838 compared to $7,000 and change. It's about $10,000 more, which in the future is like, what is this? Almost 6,000 and change in today's dollars about. Okay, so what about net worth? The net worth for the Empire Builder with 11 rentals, 12 properties total, was $7.46 million in month 480. What do you think your net worth is going to be from doing Nomad? Think it's going to be higher or lower? Higher? Why is it going to be higher? You have more properties than the other one. Net worth, if you're willing to Nomad, 2 fewer rentals, 9 rentals, 10 houses total, $11.28 million in month 480 if you're willing to Nomad. So here's the difference. This shows you doing a full 10 Nomad model, significantly better than doing even a Empire Builder 20% down model. So the more times you can convince your spouse to Nomad, probably the better off you are. Just for fun. What if you did Nomad till you got to 10, and then your spouse is like, I'm done. We've moved our last time. And you're like, no problem. I'll now buy 20% down rentals for the rest of the time. What if we did that? What do you think? How many can you buy? Mike? Where's Mike?
Investment properties, they cap you at 10 loans. With owner-occupied properties, does that happen?
Nope, there's no cap for owner occupied. You can continue to do it beyond the 10.
Does the, like on investor properties, they change your interest rate, I think, on properties 7 through 10. Does that happen on?
I have not seen the 7 through 10 increase. Have you seen 7 through 10 increase? On investor loans after loan 7?
So if you're going to portfolio lenders, then 1 through 4 is one set of interest rates, and 5 through 7 is another set, and 8 through 10 is another set, or something like that at First Bank at least. But I mean,
Conventional, I didn't think it changed at 7.
There's definitely, I mean, before there was the like, down payment thing at 1 to 4 and then above 4, right? Like, you're going to buy more than 4, you need to put 25% down. But I don't think that's in place anymore.
Yeah, I don't think so either. I don't think the interest rate change could be an overlay from your lender.
Yeah, and then you don't really have, like, you're capped with Fannie at 10, but you're not capped. Like,
and really,
there's other places to go to get loans.
10 per spouse.
It's 10 per person.
This does, like, if you had 10 investment properties and then you started nomading, did they count?
So you do 1 for one spouse, you do 10 for one spouse, and then the other spouse starts.
But it doesn't count against you, like when you go to get a loan as an investment property, if you had ones
they
that
do count
were
against
now,
you.
that
Those
were
do
now
count.
Nomad.
Yeah, those do count against you because they're now rental properties and they're loans on your portfolio.
So at a certain point, you'd have to nomad if you had more.
No, you could keep doing portfolio loans, or you could do 10 and your spouse can do 10 too, conventional. So you can get to 20 pretty easily. Then after 20, then you got to do Nomad if you want to do 30-year fixed rate financing. Otherwise, you're doing portfolio financing where you have like a 5-year arm or 7-year arm. And you got to take that risk into account.
But you could keep Nomad, like there's no cap there.
Nope. As long as you qualify for the loans.
You and your spouse could each have 10 and you could get an owner occupied.
That's correct. Okay. Yep. So how many can you buy? What do you think the number is? No one wants to guess. All right, I'll just tell you. You can get to 20 houses by month 480. How much in true cash flow? Just cash flow with depreciation benefit. What do you think? You had 10 nomads, now you added an additional 10, 20% down properties.
You're like 100 at this point.
100K? This is 40 years.
No, but if you did full Nomad to get the first 10 and now you're going to buy more?
Yeah, you're done buying those properties at like... Yeah, this is still a 40-year time period total. You're dead at this point. It doesn't feel like... Yeah. No, you're starting earlier. We'll probably show it to you here in a second. What's the cash flow? What do you think? Anyone want to guess?
25 grand.
25 grand, 15 grand. Okay, let's take a look. 19,886 per month in month 480.
What's the actual just cash flow, since you didn't include true cash flow before?
This is true cash flow. All of them have been true cash flow. All of them have been true cash flow.
It's the first time you actually put your trademark up there, so it's confusing.
I need more consistency.
And you specifically mentioned, and this includes depreciation. Yeah, but not on a slide.
This is a slide.
Everyone agrees with me. You
All right.
lost 100 burritos.
Fair enough. All right. How much is that worth? A lot. 12.56 million for that one. So here's the cash flow. The cash flow increase by buying the 20% down rental properties is not significantly better than just holding on to the nomads. Okay, it's a little bit better, but not hugely. And then net worth right here is a little bit better, but not hugely better. But what happens later on in life? What happens to standard living 50 years out or 60 years out? Yeah. Your kids are what? Yeah, your kids are balling. That's true. Okay, so conclusion. So what are your takeaways from this? What did you learn tonight? You got to move? You got to do Nomad? Is that what you took away?
I think it's to know what year you want your cash flow.
To know what year you want your cash flow. So nomading gets it earlier, right? Because you're able to acquire them earlier. If you save up 20%, it takes you longer to do. What else you guys learn? Yeah.
Certain things you do would be a ton more work for not a ton more benefit.
Certain things you do would be a ton more work for not a lot more benefit.
If you get the 10, and you start buying 20% down, and you acquire another 10 properties, you're essentially doubling your workload and your risk exposure for less than 10% increase in net worth. And
At that point, but it gets bigger over time. Like the number, like 20 years beyond that, is much bigger. Depends on what age you start. If you're doing like catch-up Nomad and you're starting at 40, yeah, it's a very different thing. Although you could make a case that with all the increase in technology, that our life expectancy is increasing, you may want to plan for 90 or 100. I don't know. There's something to be said about that. And think about this too. Wouldn't you want to have the financial resources to spend the money to pay for the high-tech stuff in order to have your life extended even more? And you can't actually plan for that then. You can't say, oh, I should go back and buy 20 more rentals now. You got to buy them early.
Unless there's technology that allows you to do that.
Unless there's technology which you could time travel. And then you got all sorts of things going for you. What else should you take away? Did I calm down a little bit at least? Okay. Cool. All right. So master your finances, learn to save money. You can get there with just the house you live in, grit and discipline of saving $160 per month, and savings from being a homeowner. So if you're willing to be disciplined, you can get to a decent number just by doing the owner-occupant property and not doing anything else if you can get 8% in the stock market, which some people believe is optimistic. But buying just one property or two properties definitely gets you a good way of the way there. And the more you buy, the better off you are. Adding rental properties helps. Equity, cash flow, and leverage. And that's it. Any final questions? Uh-oh.
So I was definitely here for this class last time because I had the same question and you didn't put it in here, which is what happens if the stock market return is just much lower? Right?
Yeah, what happens if real estate doesn't go up in value or rents go down?
Yeah, I'm less concerned about that given the historical because you're using a historical 3% appreciation that matches inflation, but your stock market return doesn't match the data we have on the stock market.
So I could definitely do Monte Carlo simulations to model that.
Right. So next time you teach this class, it's on the record.
This is the last time I'm teaching this.
You need to run it at I would like to see just 0% stock, right?
Well, that's the mattress.
Right. I agreed. I would like to see that though. I would like to see what the difference is.
I showed it to you. 0%.
Not for all those scenarios.
Oh.
Right? Like the comparison of what even one slide at the end where here's what happens if you make, 3% on your money instead of 8%, and how big of a difference actually is that? And the other thing I think here is that, you're starting everybody with 5K, and I kind of understand why you do that, but that's about a 2.5 year. If you don't have anything right now and you're saving $160 a month, it's about 2.5, 3 years to get there. So you can extend the life of everything on this out 3 years, right? But if you have 20K, then you can speed it up.
No doubt.
So I think it's important to mention those and take them into account.
And if you've got 100K, you can speed things up. If you've got $1 million, you can speed things up.
You sure can.
So this is like that. I mean, I can't go and model, well, I could, but I will not go and model every individual person's specific numbers.
Right.
Yeah. Especially for a class.
So did that take into account capital gains taxes?
There's no capital gains because you're not selling any.
Oh.
You're dying. Remember, it's 480 years.
It's not 480 years. It's 40 years. It's not 480 years. It's 40 years. Yeah, you're not selling any properties. So you're paying income tax on the income you make, but you're not paying capital gains.
No, on the money in the stock market.
You are not actually pulling it out in this particular case.
Okay. So you're
not. Oh, you mean to pull it out to use the to use them for down payments?
8% minus.
I didn't do capital gains on the down payment stuff. No, I didn't do that. So you should take that into account.
You should scrap all this and start over.
I will. Well, we've got 35 minutes, so I'll start at the beginning and I'll do that. That's probably something to add in the future. Like doing capital gains when you take out the down payment. Yeah. It's probably a good case.
Yeah, if you just had the 0%.
I gotta take into account basis then. I gotta know how much you put in and then do percentage on the gain.
Yeah, if you just do here's stuffing it in your mattress, it's somewhere between those two, right?
True.
So then you're good. Then everybody can go, okay, it's still a lot of money.
Yeah.
Nomad is still amazing.
Yeah. Fair enough. Or maybe 8% is your post-capital gains number. So you really earned 11% or whatever it is. Any final questions? Stick around for the class after the class, networking. Thank you everyone for coming. We'll see you all next week.